at some Metropole TVKE across all your social media platforms. My name is Simba Elijah Charles Kiage. You're just in time for your economic review, where we get to tell you exactly the biggest headlines that you're waking up to this morning. All right, joining us this morning to take us through our economic review, we're joined by Abraham Mudhogo, the CEO Miradi Capital. Abraham, good morning, sir.
Good morning to you.
Happy to have you around. We're also joined by Gabriel Mwendwa, who's an investment analyst. Gabriel, how are you doing, sir?
I'm good, Simba. And you?
Fantastic. Happy to have you around. All right. Great. Now, Kenya Power plans to move away from car purchases and get into the leasing of vehicles for its daily operations in a bid to address its cash flow problems. Data indicates that the Kenya Power Utility Firm spent a total of 16.9 billion shillings in the financial year to June 2020 in property and equipment purchases like transmission wires, transformers and vehicles, with the data putting the total vehicles fleet at the company at 2,269 vehicles. This new announcement came from Kenya Power's expression of interest notice at a time when the company is going through radical reforms that will see power costs reduced in the country by 30%. The utility firm bounced back from a 939 million full year net loss to post a 1.48 billion after-tax profit for the financial year to June 2021, largely boosted by lower costs and a higher revenue collection, but its technical insolvency still overshadowed the result. Kenya Power reduced its expenses to 39.86 billion in the year to June, down from 47.83 billion last year. Fantastic. Let's look at exactly where they are, therefore, in that 6 months period. And you will see that when you look at net income after taxes, they jumped to 138.36 B. So when you look at net income before taxes, they were at exactly 332.66 B. Sort of jumping from where they were last year. And that's the data that we look at next, because they closed last year at a profit margin of negative 459.2 when you go back to 2019. That's a huge drop in that profitability. That's exactly what we're talking about. 2020, they closed at 939.48 million, almost a billion in terms of losses. Fantastic. Abraham, let me begin with you as well. Just as we start again, Kenya Power, again this morning, in that expression of interest again, what we realize within that is that they're also looking into internet connectivity in the rural areas as well as another viable option for them, just to, I say, marshal capital as well, because they're saying that the network of wires in the rural areas can also be used as a tool for rural internet connectivity. But that on the side as well, this car leasing as well. I mean, we could talk about the car leasing specifically on that, but then there is a lot that is going on at Kenya Power right now. A viable option for them, or just a flurry of suggestions that again will turn out not to be really good for Kenya Power?
No, leasing is a fantastic option.
Yes.
I think it's been done by many companies, and is a way of creating cash in the company, because basically two things. One, you don't have to pay for your asset upfront. You get use of the asset and pay for it per month without having to own the asset.
Yes.
That's number one. Number two, the leasing company can go further and buy what you have and then lease it back to you. So theoretically speaking, like that 16 billion, maybe half of it or three-quarters of it, they could be given back.
Yes.
Cash. Then they do lease payments. The best part about it also, those lease payments are tax deductible. So it's a fantastic option, if you ask me. And in fact, the question is, what took us so long?
Yes.
And I think you know why. Because I think in terms of, from a procurement perspective, if you want to make money, it's more lucrative to buy than
as opposed to lease.
But for the company, I think the option of leasing is fantastic. So I think, I hope they follow it through. There are many good leasing companies, both driven by banks and also independent ones. So I believe that could work. That could definitely work. Yeah.
Pretty much. All right, Gabriel, let me also come to you on that. I mean, when you look at leasing as an option, we've seen a lot of state agencies that are really looking to address their cash flow issues, take to leasing as a proper option. Is the way to go for Kenya Power?
It is, and I'll agree with my fellow panelists.
Yes.
So we've seen even a lot of private companies switch to that model, especially whereby you have heavy use of the said vehicles, because then you sort of cut back on your repairs and maintenance. Probably you cut back again on downtime, because you see, if a car is down, you can then maybe request for another replacement if you have some short term. Of course, the leases are more long term, but then you can ask for a short term replacement at no extra cost. If the car is damaged, the process is much smoother. It's just easier just having this item off your balance sheet cost wise, and then even replacing your fleet is quite easier on a lease basis than on a if you're doing this buying. And then again, a very key element, you notice the finance cost of this company are high. So instead of borrowing to buy a car, you just pay the person you're leasing from the same amount you probably have been paying a lender to give you the money to go buy the actual car. So it's a way easier model, simplifies the loopholes or reduces the loopholes that would have come in procurement of spare parts of the car themselves. So it's bound to save them some cash. I don't think it's the one thing which takes KPLC from where it is back to where it was, but it's a step in the right direction.
Pretty much. All right. Now, Abraham, let's talk about that as well, because what is really a conversation point for KPLC is that technical insolvency as well. Do you think that some of these plans here would actually move Kenya Power out of that spot for being technically insolvent?
You see, first of all, technical insolvency means
Yes.
that their current liabilities exceed their current assets.
Yes.
Which means that on a going concern, if all your liabilities popped in through the front door, you'll not have enough money to pay.
Indeed.
That's what it means. So now let's look at it bit by bit. If for example, you're leasing, and if you're leasing, it means, and you do, especially if you do a sell and lease back.
Yes.
Money moves from your fixed assets to cash. So what would that do? Yes, that would improve your current assets, because the cash item would go up. So if it is significant enough, then it may be it may assist in driving them out of insolvency. Because for you to get out of insolvency, either your liabilities have to shrink,
Yes,
or your current liabilities have to shrink, or your current assets have to go up. In this scenario, they would go up because a chunk would move from your fixed assets to your cash. So yes, it will be a step in the right direction. It may not be the magic bullet, but it will be one of those things that would start fixing that problem.
Yes, pretty much. Now, Gabriel, let me just talk about that particular point that Abraham is raising this morning, because we do know that the government actually plans to bail out Kenya Power again in a 2022-2023 financial year. I mean, all these radical reforms that we're seeing at Kenya Power right now, should have they waited the bailout? Because then you're sitting here and wondering, you want to bail out Kenya Power. That means that you're really looking at their books and saying, whatever problem you're in, we're going to wipe it out. Should have these radical reforms waited their bailout?
Well, yes, because not should have waited for, but if you're a KPLC or you're a company, you only act when the auctioneers are at your door, or the court cases at your door, or when your lenders are at your door. So there was no scenario under which it would act on its own, call it volition.
Yes.
Unless pushed by the government or shareholders or the lenders. So I think that's where this is coming from, because remember, if we're saying the failures are because of misappropriation, what does that tell you? It means there are culprits within the company who are perpetuating this.
Yes.
So there's no incentive for any of them to stop, to scale back, unless there's actually a higher power who has come in, and you have no choice to stop, or you get in problems. So that's that. To call it an incentive, that's the incentive they have to reform, because they need this money. It's the same thing that even Kenya does with IMF. We need the money, so we have to listen to what they say.
Yes.
So I think it's as simple as that, yeah.
Pretty much. Now, Abraham, again, when we're talking about this, I mean, we're talking about this again when the president has already promised Kenyans that by 31st December 2021, as we cross into the new year, power costs in the country are going to be reduced by 30%. Fine. But here's a company telling you, well, it's when we're going through reforms now, just to address our cash flow issues, meaning it might take time before we see some of these reforms actually start to reflect in the balance sheet for Kenya Power. And now, on the other side, the president actually does want power costs in the country to reduce by 30%. Wrong time to address power costs for a company that is addressing insolvency and cash flow issues?
See, the president has made an executive order.
Yes.
So if the order has been made, the order will be carried out. Now, let's get into the details of how that will be carried out.
Yes.
The truth of the matter is that the time horizon is too short for those curative measures to have kicked in.
Yes.
So the only option that you have is for them to cut back on their profitability or increase their losses. That there's no other way out.
Yes.
Because that order will be carried out. Because an executive order is an executive order. It has to be carried out. There are no ways about it. So in the short run, I want to believe that they'll either cut back on their profitability that they've started to build up,
yes,
so that they push back that by 30, or increase their losses to cushion that 30. But the mid and long term, if all these measures are put in, if you're able to negotiate the PPAs, if you're able to pull back through leasing and other cost-cutting measures that they are about to put into place, then in the mid and long term, then that now will happen from a financial and from an operating perspective.
Yes.
But from the initial, it will just be driven that there's a policy of 30% cutback, then let the chips fall where they may.
Pretty much. All right, Gabriel, as we end this conversation, same question I put to Abraham this morning, that is a company that is still technically insolvent, meaning that they need more capital to be pumped into that company so they could balance their liabilities and assets. But on the other side as well, even as we talk about these reforms, the president does want power costs in the country to be reduced by 30%. Is it the wrong time to talk about power costs for a company that's going through radical reforms?
It's bigger than the reduction of power costs is not really about KPLC. It's
yes,
bigger than KPLC. It's political, it's social, it's everything.
Yes.
It has more to do about, I think KPLC's profitability is the last thing the government is thinking about when they say they want to reduce power costs by 30%.
Gabriel, I'm sorry to cut you short as well. Is it interesting you should say that KPLC's profitability is the last thing that the government is thinking about, but this is a publicly listed company, Gabriel? We can also ask that question because profitability is a key issue for a listed company.
Yeah, definitely. It is a concern for shareholders, the others, the small ones, you and I,
yes,
or any other institutional shareholders who are looking for a return. But from what we've seen from the government, I don't think that is their concern with KPLC right now, in terms of it's not about profitability. Yes, they like that they can say it's profitable, but it's not like they're looking for a dividend or something. They just want the company to be stable enough to deliver on their political and social projects, because
yes,
it is an avenue of service delivery as far as the government is concerned, which
yes,
is very key for the government than any profits that KPLC can bring on board. So it's really just a channel that is going to be used to ensure that we achieve that 30%. Whether we achieve it or not, of course, is an entirely other question. But yeah, I don't think profitability is the biggest headache for those who want to reduce power costs at the moment.
Pretty much. Abraham, clear this then. KPLC being a government project,
Yeah.
and KPLC being a publicly listed company, meaning that you and I also have an interest in the running of that company. Where's the balance? Should we take KPLC off NSA?
No, and that's why you're told they're the single largest, they're the majority shareholder.
Yes.
That's why it is also a parastatal.
Yes.
So that dual nature of its ownership and its nature is what is playing out. Remember, when you have 51% control of any company, you call the shots.
Yes.
So they are calling the shots. So the rest of the 49 have to tag along. there are no two ways about it, unless they can be able to come and become majority. But now that they're majority,
yes,
they'll run their agenda, and as my colleague has said, yes, there's an agenda to be delivered. Connectivity of power, powering of industries is very critical.
Yes.
So when you're looking at economic return, then sometimes financial return is sacrificed in the short term.
Yes.
Financial return can come later, but the economic return and the economic agenda precedes the financial one.
Pretty much. All right, let's move on to the next story this morning, where plans by Centum Investment Group to buy back their shares seems to be moving even closer after the group chief executive officer, James Moria, said the company's board of directors has requested a team to review the plans and give recommendations for consideration. In an interview on November 29th, James Moria confirmed that the move will give a chance to minority investors who wish to exit the company to do so, and allow those who want to stay for the long term to ride it out. Recent years have seen Centum's share price slumped to 3.7% year to date. But this drop took a turn for the worse as the company grappled with negative publicity of its growth prospects, a factor that has seen the stock drop 12% since November 9th. Now, the Centum stock is currently trading at a massive discount as management of or pegs the value of each of the company's shares at 62 shillings and 10 cents. Interesting. Let's look at exactly where they are, and that's Centum share price. And we're looking at that monthly average, and you can see exactly where they are in December. A big drop again from November. I mean, they were doing it around 15.5 in November, and you can see exactly how they dropped to December, and that's the negative publicity about their growth prospects that actually did affect that company. And so when we look at where they are again, we do know that things are not been really bad for them in the first 6 months of 2021. They did record a jump in profitability, and in the first 6 months of 2021. Again, if you look at where we are from in 2021, again, that loss after tax is exactly what we also have to look at, especially when it comes to Centum, and we're going to talk about this morning. But Abraham, let's talk about Centum itself. The intrinsic value for Centum, yes, could be very high. And that's exactly what we're talking about, 62 shillings and 10 cents. But they're not there yet. For you, when you look at Centum, where is the conversation point?
See, Centum has been on this journey, this downward journey for a while.
Yes.
If you go almost 5 years back, you'll see that there was a phase of sell-off. They sold off whatever they could sell and kept afloat.
Yes.
Then they went to a phase of revaluing their properties and booked gains on them and remained profitable. Now all that has run out. Now they're stuck with several projects. Akira, Two Rivers,
yes,
Amo Power, just to name a few. They're stuck with those, and those are not looking good. And a lot of money has been sunk in that. So the return on that is simply not there, and that is what is contributing to this loss, in my opinion. And I think that's why they would want to buy back, because I think for them to come out of this, it will take a while. And for me personally, if I was asked, I think they have to revise their entire model of how they do business.
Yes.
Because whatever they have been doing is not working.
Yes.
I don't think it's going to work anymore.
Yes.
So I think it's time they cut their losses and review their model and come up with a new one.
Pretty much.
Yes.
Abraham, I will be coming back to you on that, because I was speaking to the CEO of Abujani Investment last week, saying that he doesn't think that share buyback is really an option for the NSE right now. The companies have to first add value to their models before they think about going into share buyback, because we do know it's not just a common practice at the NSA. Same question I want to put to you, Gabriel, this morning. For you, when you look at Centum, is share buyback the option out?
Depends on where you're sitting, Simba. So
yes.
If I was sitting with management and the board, and going by their sentiments that the current valuation that the NSC is offering is below their perceived book value,
yes,
that they have significant confidence in, then we're basically saying we're making an investment at a significant discount. So
Yes.
why not? If I was to look at it as an investment we're making, then we would be saying that we actually have significant insight into the value of this company because we are that company. So we can, if we say our book value is, let's say, 62 shillings, we can even stress test it and say it's, let's say, 50, 55 shillings. And if we are confident about that number and NSE is offering a price which is below even 20 shillings, if we get an investment vehicle for less than 50%.
Yes.
So why not buy? And that's the time you buy. So you buy when the market sort of has a misconception about your price, your value, etc. You don't buy when it's high or when you've already created the value.
Yes.
Because that's when you sell back to the market after you've created the value so that you can sell it at a higher price. So I think based on their own sentiments, it's the right time. But then again, if you sit on the side of market players and shareholders at the NSE, investors at the NSE, then Centum has not excited the market for a while now. And I think that's a problem. They were used to, the share drive was driven by excitement. You know, there was a deal coming through. They were in the news quite significantly. But, you know, you need that. So short-term investors are no longer sort of keen on it. Long-term investors, of course, if you look at the projects keenly, there are quite a number which sort of make sense and are picking off very well if you look at their reports. So long-term still remains well, but there's no excitement in the short term to drive that share price high. So they might even do the share buyback and you might not see an impact on the share price as might be expected in some cases.
Yes.
So yeah, it depends on where you're sitting, Simba.
That's exactly what I want you to pick from again, Gabriel, because you've said that, well, they might actually get in that share buyback and then you don't get to see the impact of that share buyback. But if you listen to that statement from James Moria, he's saying that for those smaller investors who want to exit, we're giving them that opportunity, and we want to stick with those bigger investors who want to stay for the long term. It looks as if for them it's not recovery in the short term, it's just to stick with people who know that the project they are in would actually account to something in the long term. Is that what it is, Gabriel, when you look at it?
He's just using very many words to control, to say he's controlling optics. I have a lot of respect for Moria.
Yes.
And he's worked with them, excellent people. But you see, it doesn't matter the nature of your investors, short term or long term. You've not come to the NSE to raise money.
Yes.
So it really, your share price is irrelevant to you. Because yes, you have shareholders, but shareholder returns, as far as he is concerned and he and his board, is whatever value they can generate, the net asset value of that company, and they say they're doing well. So beyond that, the price of the NSE cannot be a primary decision-making input for them, because whether you are a short-term or long-term investor, it does not matter, because you're not buying the shares from Centum. You're
Yes.
buying the shares from Gabriel, you're buying the shares from Simba. End of story. So long-term, short-term does not matter. And then you see short-term investors actually allow for price discovery, because if you're only left with long-term investors and no one is trading a portion of their shares, what does that mean? It means even the share price will never move because there's no volumes that are being traded. So saying you need long-term investors is if you're doing a private equity investment. If you're doing a listed investment, then I recommend you have a mix of both. And it does not matter to you unless they're telling us they're planning to come do a rights issue. That's when it matters. If they're not planning to do a rights issue, it really is not. I don't see why it should be something that really bothers them. Like I said, it's okay. They consider Centum a very good investment.
Yes.
They have very good insight into the company. So if they feel the price of the NSE is at a discount, let them come buy it. No problem. They're making an investment. They'll be for sure spending their money on something good. But you know, the idea of sticking with long-term investors doesn't work or is not the right approach when you're dealing with public markets.
Pretty much. All right, Abraham, just quickly so we take a short break. I mean, if we're going to really look at exactly how share buybacks work in the economy, we've got to look at Nation Media that went into a share buyback. But again, I mean, it's been hot and cold for them as well. And I think if you look at exactly how the markets closed yesterday, Nation Media again was among those top 5 in the losers list. I don't know, Eugene, if you could show us that data this morning. I mean, can we look at national media and say that share buyback is not essentially what is going to correct your share price in the short term? Because if you look at exactly what Centum is going for, they feel like it's been a long time. Our stock has been operating on a massive discount. We have to correct it now. Are we looking at national media and saying it might not be?
I think I think, as my colleague is saying, I think they go in
Yes.
to mop up their shares.
Yes.
Because they believe they're worth more. So basically, they are mopping them up to preserve their value, and two, of course, you're also reducing the liquidity of,
Yes.
of those shares.
Yes.
And by so doing, through the demand and supply, hoping that also that price goes up. But I think the primary reason why buyback is done is because you believe, sitting on the inside, that your book value or what you perceive to its value is much higher than what the market is offering.
Yes.
And so by buying, it makes financial sense. But at the same time, you're able to now have more of that and preserve the value of your company.
Yes. Pretty much. All right, Gabriel, once we come back, there's that drastic drop of a Centum share price again. I mean, is it time that they want to go back to the market and get their shares off the market? But again, one thing is evident as well, is that if you look at where they were from November up to where they are now in December, there's been a massive drop. They've shed off 12%. That share price as well. What could be going on? And indeed, is the share buyback plan could be exciting the market, but it looks as if it's not, Gabriel. Let's talk about that once we come back here on Metropole Television.